If you're looking to generate income from your investments without picking individual stocks, you may have considered dividend ETFs. But with so many to choose from, how do you know which is the best to pick? I've covered different dividend options in previous videos, but for this one, I'm going to focus specifically on global dividend ETFs, which are among some of the more diversified options available. I'll also explain all the key stuff so you know what to look for when comparing them, and go through some of the best options available right now. One of the biggest mistakes I see people make when choosing a dividend ETF is simply looking at the yield. And this is an issue because it only tells part of the story. Let me show you an example. First, I'm going to use just ETF to filter down to create a shortlist for the ones that we want to look at. So we can select equity, and then in equity strategy, we can select dividend. Because we're going to focus on global dividend ETFs, in region, I can select world. And then we're already down to 20. From there, I'm just going to select 3 typical filters that I tend to always use. The first is older than 1 year, just to make sure we've got a track record to look at. Use of profit, we want distributing because we want the dividend to be paid out to us. And then fund size, I always tend to use larger than 100 million, just to make sure we're looking at some of the more reputable providers, but also to make sure there's no liquidity issues with really small funds. And from there, we've just got 8 to look at. Now, if I sort by dividend yield, you'll see that one at the top is called Global X Super Dividend, and that has a yield of 9.51%, more than double that of the next closest one. And the reason I said the yield only makes up part of the story is that it doesn't tell you the state of the companies that are paying out the dividends. And it also doesn't include capital appreciation. When we look at performance figures, many websites, just like this one, will have dividends reinvested included in the performance figures. So when we dig a little bit deeper and we look at the performance for this ETF, if we look over 3 years, it'll say it's done 23.34%. However, when we don't include the dividends, it's actually down 11.24%. So although you'd have been getting a very decent yield, close to 10%, your portfolio would actually be down 11%. And therefore, for the same yield, you'd actually be getting less of a payment each time. And when we look at the index that this ETF is tracking, it's simply focusing on high dividend yields from all around the world. And this is significant because just focusing on the yield doesn't tell you the state of the company that is paying out that dividend. A dividend can be a massive attractor to both existing and new investors. And if you're evaluating a single company, you'd be interested in their payout ratio. So that's the percentage of their profits that they're paying out in a dividend. And for some companies, this can be over 100%, which is clearly not sustainable because they're paying out more than they actually earn. And they do this because they want to keep that investment coming in. And in some cases, companies will even go into debt in order to pay out a dividend. You would also look at their dividend history, and you would want to see a gradual increase in that dividend. Because if you have a sustainable growing business, they should be able to afford to continue to increase that dividend that they pay out each time. If you were to see a company pay a one-off dividend and then massively reduce it again, that doesn't give you the confidence that it can sustain that level of dividends over a long period of time. And when we look at the dividend history for this ETF, there's not loads of data to go on, but you can see it's actually been reducing. So in 2023, it was 93 pence, then it was 77, and in the last year, it's been 71. So although it looks like some of the companies have started to recover in the last year, looking at the dividend data, it doesn't give me enough confidence to include it in the shortlist. So from the 8 that we filtered, I'm going to untick that super dividend ETF. And then I'm also going to untick this X-Trackers ETF. There's 3 main reasons I wouldn't include this in the shortlist. You can see it's the most expensive at 0.5%. I also tend to prefer big name brands, and X-Trackers, although it's been around a little while now, is not one of the big household names. That's just a personal preference. And it also uses swaps to track the index rather than physical replication, which I think just adds a level of complexity that most investors can avoid. I'll go into more detail on that another time. And then we've just got 6 to look at, and all of these will have various pros and cons. But what we can do on just ETF is compare these in more detail. And the first thing we can look at is a chart comparison. Now, I wouldn't put too much emphasis on this past performance because there's no guarantee that this is going to continue. You can see they're fairly well correlated. Even all of the dips, even these increases, these little dips here, are all fairly consistent between the 6. There is a standout with the VanEck ETF, which is higher than the others. There's no guarantee that will keep being higher going forward. What I would be looking at here is general volatility, because especially with a dividend ETF, if you're having that income paid out, you want that to be as stable as possible. And this goes back to our yield point, because sometimes an ETF with a slightly lower yield could be more consistent and more stable, and that's going to give you more certainty into the future. So I generally look at that over a few different time periods. You could pick out a few. So for example, this bottom one here, this is the SPDR S&P Global Dividend Aristocrats ETF. You could look at its low performance compared to the others. For example, it's done 18.72% over the last 3 years, compared to the VanEck ETF, which has done 53.97%. You could look at this 2 different ways. Are these slightly undervalued, which means they might have more runway in the future? Or is there a reason they're not being priced in right now? And that lackluster performance could be that people are pricing in that those companies might not have the biggest growth prospects. If we scroll down, we can look at some of the other data that we can compare between these 6. Now, there's not going to be one thing that's going to be the determining factor that's going to make you decide to go down one route. With all of these ETFs, they've all got pros and cons, and it's a case of working through each of these data points and working out how important that is to you. For example, if sustainability, i.e. ESG, is really important to you, you can already rule out 3 of these because the SPDR, the Vanguard, and the Franklin ETFs are deemed not sustainable. So then you're only looking at 3. The next thing I would look at is volatility, especially for a dividend ETF. And in that case, the VanEck ETF has the lowest volatility here at 10.76% compared to the Fidelity ETF, which has 15.04%. This is how much the ETF has fluctuated in the last year. The next thing I'd look at is dividend frequency. All of these ETFs pay out quarterly, but sometimes you will see ETFs either pay semi-annually or even monthly. The next thing is where the fund is domiciled. 5 of these 6 are domiciled in Ireland, whereas the VanEck ETF is domiciled in the Netherlands. And this is important because different countries will have what's called a withholding tax, and the Netherlands have a 15% withholding tax. That means as a UK investor, when you look at the yield, you have to reduce that by 15% to have an idea of what you might get paid out. Again, that shouldn't be a determining factor. It's just another thing that you need to consider because that fund might still outperform all of the others, even when you take off 15% of that yield. One of the more important things to consider with these ETFs are its holdings in combination with its weighting by country and sector. Starting with the number of holdings, and here we can see a massive difference. If we look at the Vanguard ETF, this is what I'd call your vanilla fund. It's the most diversified because it's the biggest in terms of number of holdings. You can see it holds over 2,000 companies in the ETF, and you can see that in the weighting by top 10 holdings is only 11.64%. We compare that to the VanEck ETF. It has 100 holdings, and therefore the weighting of the top 10 increases to 34.58%. So you're putting a lot more concentration and faith in a smaller number of companies in the VanEck compared to the Vanguard fund. So the VanEck has less diversification, but it could also be picking the ones that have been winning, the ones that have been paying out the sustainable dividends. So you can look at that both ways. It's important we look at this in combination with the weighting by country and sector. And a big topic this year has been investors starting to get concerned with the weighting to the US in a global ETF. Although the US has massively outperformed in recent years, investors are starting to question, are we in an AI bubble that's been driven by big tech companies? And is now the time to start reducing exposure? The SPDR ETF, the Fidelity, Franklin, and iShares ETF all have a very large stake in the US in terms of weighting by country, with the standout being the VanEck ETF, which is much more spread out across the rest of the world, with specifically France and the UK making up more of a proportion. This is interesting because the VanEck was the one which had the highest concentration in its top 10. So you could look at the top 10 holdings and suggest that it's got less diversification than something like the Vanguard or some of the others. When you look at weighting by country, it's got the most diversification because it's more spread out compared to the others. We can also look at that in relation to the weightings by sector. And you can see for the iShares and Fidelity, which both have the highest weighting to the US, also have the highest weighting towards technology. So if you look at the weightings and feel like you're not as concerned with a weighting towards the US, but you are specifically towards the Mag 7, for example, those are 2 you may want to avoid. If we then look at the Franklin and the SPDR ETFs, which also both have the US as its highest weighting, it's then not technology, which is the highest sector. It's then financials, both around 22%. And you'll tend to see financials heavily across most dividend ETFs because historically they've been really good dividend payers, very sustainable, and they've been able to grow that dividend over many, many years. They can have their downsides though, and when you look at the VanEck ETF, 40% is weighted towards financials, which is a very high percentage for one sector. It goes somewhat to explain why it's performed so well, especially compared to the others, but you do have to question whether you're okay with the risk of having 40% towards financials. The counter to that is healthcare, energy, and utilities are its next 3 weightings by sector, and all of those are fairly defensive in nature. So even in a market downturn, if the market were to crash, those sectors will be slightly more protected because consumers still need those products and services. And then onto the yields, and arguably the thing that most people will focus on. And in a way, it's good that in this comparison, dividends are towards the bottom because you should already have a rough idea of which ETF you might want to pick by looking at all of the previous data. When we come to the dividend yield, it's more of just a confirmation because sometimes picking a dividend ETF with a slightly lower yield could actually put you in a better position long term because it's important to take into account total return. It's the same thing when you look at an individual company, and every company that makes a profit has a decision to make. They can either reinvest those profits back into the company for further growth, or it can pay out a portion of those profits to its shareholders as a reward and also an incentive for new investors. So as an investor, you're either going to gain from capital appreciation or you're going to gain from receiving the income, or a combination of both. And one final thing when looking at dividend yields, especially for ETFs, is just looking at the sustainability. And none of these are stand out in terms of it not looking like it's sustainable. I would look at the actual amounts rather than the percentages because of that capital appreciation, which can change the percentage even for the same dividend. And you can see, although they've fluctuated across all 6, they've not been directly dropping year on year. There has been times, for example, in 2024, that some of them reduced that dividend, but then they increased them again the year after. If you were seeing across 2021, 22, 23, 24, that it was consistently reducing those dividends, then I would look at that and think, this is not sustainable, and probably one that I would avoid. So really what it comes down to when you're picking between a shortlist like this is what your view is on the weightings. Do you have a particular preference or concern with a particular country or region or a sector? Are you okay with the concentration in a small handful of companies? Or do you simply want the ETF with the lowest volatility? It may not perform as well as the others. It may not have as high dividend yield, but it's going to be a lot more stable and you can be much more confident going into the future, especially if you're drawing on that income for retirement. You want that income to be as stable as possible, so you can have that certainty on future payments. I hope you found it useful, and I'll catch you in the next one.